I'm Dave Mecklenburg. Welcome to another Festival of Traders event. Before we begin, I want to remind you there's a high degree of risk in trading. If you've been trading for more than one day, you know that you can and will lose money trading. Only trade with money you can afford to lose. Our presenter today has been trading currency for over 13 years. He specializes in swing trading and trading reactions to the news. You can find him at Day Traders FX. Please welcome Jared Johnson.
Thank you for having me, guys. Lovely to be with you this afternoon. It's always a pleasure to spend some time with traders. Trading is a daily diet for me, and working with new traders is also something I do on a daily basis. So it's always a pleasure. So thank you for having me. I wanted to talk a little bit today on how to improve some trade entries. This is not necessarily a market-specific situation, so we'll get into all of that. This is just trading in general, and there's going to be some good general concepts that you guys can apply to stocks and futures and commodities and all kinds of fantastic things. But quick little intro on myself. First of all, I like pink shirts. And I cannot lie. You can find me at daytradersfx.com. If you have any questions about anything you hear today, you can send me an email at jared@daytradersfx.com. Or as always, you can follow me on Twitter, daytradersfx. On Twitter. So I send out lots of charts and trade ideas and things I'm working on and doing and so on. So stop by one of those three places. I'd love to hear from you. I'd love to answer any questions you have about today's presentation or about anything that I do in general. Happy to chat with anybody. I love meeting new traders and working with people. Okay, so as mentioned, how can we improve trade entries? This is something that's kind of an age-old situation. I do quite a bit of one-on-one sessions. I guess you could call it coaching of sorts. I help new traders achieve more profitability, and I help existing traders, people that have been profitable and are doing well, to kind of reach that next level. I like to call myself, you know, the coach of Tiger Woods kind of a situation. So I try to help people from all levels: beginners, intermediate, advanced traders. I have fund managers that I consult, and so on. And here is one thing that I find overwhelmingly true with these people that I work with, and it doesn't matter what market they're in. It's just it seems to be a very common theme. I find that traders are very often, and if I dare say so, almost always correct about the direction of the market. It's interesting when we're those people that kind of have our pulse on the market, like we all do. Most of us are watching charts on a semi-regular basis, whether it's daily or a couple of times a week. That gives us a major kind of inside track on what the market is doing, as opposed to the average person that's just maybe putting some money in a 401k or, you know, in a mutual fund, and they're trying to keep a half of an eye on the market every couple months. So I find that traders are very, very often correct about the direction of the market. If you're looking at the charts a couple times a week, chances are that you know which way things are going. Where's the big problem? The entry. That's our big problem. That's where so many traders have failed to achieve either the level of success they want or any success at all. If you're new at trading and you're finding yourself losing on a semi-regular basis, I would bet a lot that 80% of the problem is the entry and not the actual direction of the market. I always say it's our job as traders is very simple. We have to determine which way the market's going, we have to determine where to get in, and we have to determine where to get out. We have three things to do. Unfortunately, at least two of those three things have proven to be very, very complicated and difficult, and one of them is only very complicated and difficult. So even though it's a small couple of things that we have to do as traders, it can be tricky. And I have found that in almost every case, the entry is the problem. So let's not beat ourselves up. We're never going to get it perfect. That's just, you know, you just can't. Nobody bats 1,000. Nobody scores a perfect. No one misses a shot. You know, that's just not how it goes. So we're never going to get it perfect, but we can definitely improve our entries with just a simple concept that we're going to talk about. It's a few simple concepts, but one thing in particular really hopefully will stand out to you guys, and I've seen that it has helped many of the traders that I have worked with. Finally, I would like to recommend that everybody become very, very good friends with your account history. Whatever type of trading you're doing, look at your account history. Make sure that you're keeping a running tally of the trades that you're taking, because you're going to need to go back and look at these trades and do a couple of things that we'll talk about in this presentation. Okay. Let's just take, for example, now as we mentioned, the ideal entry in this last slide. This is what we're looking for, right? The ideal entry. Where is this ideal entry? What is this ideal entry? Well, let me give you an example here. The euro dollar just happens to be something that stands out to me. We saw some European Central Bank news on Thursday. I think it was Thursday. It was Thursday morning. The European Central Bank said some stuff. Everybody was getting really bearish about the euro, that the euro was headed down, and even Goldman Sachs said we expect the euro versus the US dollar to be at parity, 1-to-1, by the end of this month. Goldman Sachs said this. And everything went the exact opposite way, because the central bank in Europe said things are maybe not quite as bad as we think. Or as everybody was thinking. So regardless of what they said, this is what happened. This is the big reaction that we saw on the euro versus the US dollar. This is a 1-hour chart. So in just a couple of hours right here, we saw massive spikes, and then taking a little breather, and then over the next couple of hours we saw some big continued movements for a total of about 450 pips worth of movement in just a couple of hour period. That's a huge movement for any currency pair, for any market, for anything. That's a big movement. So what is this ideal entry, and what are we trying to accomplish here? Well, I have personally been watching a couple of levels on the euro dollar, and this little guy just happened to be one of them, and you can see why here. We had a nice little resistance level that had been tested over the last several days multiple times, and you can see that area 106.30, 38, 40-ish area right around there. That was a nice little resistance zone. And a place that I would want to be in this trade if it broke above this level. Little tiny consolidation, it breaks above that level. I want to be in this trade. So I want to be in this trade as close to this breakout area as possible. You can kind of determine what as close as possible means for you. For me, it's a couple of pips, 10, 15 pips at the most, is kind of where I want to be getting into this trade. This is a big, news announcement, a lot of activity, and so on. So I want to be in this thing really close to that breakout area. And that's where I want to be getting in. That's the ideal entry. This is where we should be getting into this trade, at the break of this major resistance level, and we want to get in very close to that so that we can ride as much of this up as possible. So that is our ideal entry. Now, inevitably, I've already seen this. I've seen screenshots, and people have sent me emails and comments and so on. Inevitably, people see these big movements right here, and then again, I got a lot of emails and so on of people saying, okay, I got in here because I thought this was going to keep going. And it seems to be nearly impossible to pick tops and bottoms unless we're picking the opposite top or bottom that we're looking for. So nobody was selling up here, nobody was shorting this up here. They were all still trying to buy and get long. And of course, this has started to pull back and retrace a whole bunch. Now, we never know where it's going to stop. We never know how high this is going to go. But what we do know is that this was the ideal entry. And the further away we're entering from this entry point here, the worse off our trade has the potential of turning out to be. The higher risk the trade is getting, the further away from an entry point that we get in, the closer we're getting to that reversal point, and we're progressively getting further away from the reason that we got into the trade in the first place. So this was our ideal entry. People were getting in long, buying in this whole area as this has continued to run down and down and down. And so it's such a, you guys might be thinking to yourselves, this is kind of an obvious concept. Of course, I don't want to get in at the top of this thing, especially as I'm looking back at this chart. I want to buy here, and I want to sell out of my position right here and make all that money 100%. That's definitely not what we're saying, but we're saying that it is ideal to find an area where if you were not in the trade, that's where you would want to be in the trade. And if you're in the trade and that continues to happen, you know, this breakout and this entry and all this stuff continues to run, and it's just confirming your entry, then that's totally great as well. But here's our ideal entry, and anything else right here is telling us that we need to wait for the next setup. So here's a couple of things to kind of keep in mind from just that simple chart right there. Anytime we look for an entry, I want you to look back at least 12 hours for an obvious entry. Now, I say 12 hours as kind of a base point to kind of you know, base some of that decision on. But basically, I want you to look back to the previous session. Did we miss anything since the last session of trading that was a better entry than what we're trying to get into right now? And typically, you know, if we look back about 12 hours, you know, 14, 16 hours, somewhere in there, we can get a pretty good idea of what the recent movement has been. Now, from session to session, you know, Monday to Tuesday to Wednesday, the market has time to consolidate and pull back and give us another setup and so on. So we just want to kind of look to that previous session and see if there was anything obvious that we missed. If we did miss a big move, patience is key. Let's just simply wait for the next setup. If you go to any chart, whether this is Microsoft or the euro versus the US dollar or gold or corn, if you miss this big move right here, no problem, no problem. Stay out of it. It doesn't matter if this goes another 500 pips up. It doesn't even matter, because all we're going to do is we're going to wait for the next setup. Everything that I do is setup based. I'm not trying to necessarily teach a new trading concept here, or excuse me, a new trading system. I'm just trying to teach a few principles that you can apply to whatever kind of trading you're already doing. So here is that ideal entry. It's made its move. We're just going to wait for the next big setup. Especially in something like this, you know, we can find a nice chart pattern like a bull flag or something else to get into on the re-entry and take it from there. But after that ideal entry, after that breakout, after that perfect area that we wanted to get in, every pip or every point that the market moves away from that, we're getting that much closer to a point where it's going to reverse on us and possibly go the other way, stop us out, do all of that good stuff. So patience is super important. Just wait for that next big setup. I want everybody to go and review the last 10 or 15 trades that you've taken and just look back several hours, look back a day or so, and see if where you got in, if there was something within the last day from your entry that would have been a better entry. That if you would have identified that, you may have possibly stayed out of the trade that you got into, especially if it didn't turn out to be a winning trade. So this is one thing where we've, you know, got to really bust out that account history and make sure that we're keeping super close track of that, and that we're identifying our trades against some of these criteria right here. Okay, here is another possibility. I love watching currencies, and I'm a big currency trader. This is the Canadian dollar, well, the US dollar versus the Canadian dollar. This one follows oil a decent amount, and we've seen oil just kind of going down and down and down, and the Canadian dollar is weakening and going down with it. So we have the US dollar versus the Canadian dollar right here, and this level may not look very significant. This is a 4-hour chart, 240-minute chart. But this actually goes back several months. This level right here goes back several months, and it's something I've been watching very closely. So on the daily chart, you can see that this is a big double top right here. This being the second part of the double top, and then it breaks through right here. So very significant level. I've been looking to get long at the break of this double top. So let's say that we look at the chart right now and we say, okay, well, this is broken past that resistance level. That was our ideal entry right there. Now what are we going to do? Well, the euro dollar ran up hundreds and hundreds and hundreds of points, whereas this dollar Canadian pair has only run up, you know, 50, 60, 70 points. So it's more of a reasonable movement that we can expect a bit of a pullback, and we can get an opportunity to buy that retest and get into that trade. But because we've been very anxiously waiting for this this move and this setup and this breakout, we definitely don't want to just jump on this thing the moment that it breaks and the moment that it goes. We want to once again give this an opportunity to pull back, get us an entry at that retest, and then away we go. Again, a very simple concept. I guarantee that there's nobody here that has never heard of waiting for a pullback or waiting for a retest. Yet, however, all the people that I work with have also heard that. Wait for the pullback, wait for the retest, wait for the next big setup. Yet somehow, so many of the trades that I see people doing are trades that when you go back and look at it in your account history, you wonder to yourself, why did I do that? And especially in kind of comparison to this chart here of, was there a huge movement? Where's the next big setup? Why am I getting to this trade? One thing that I always tell everybody to do is just keep a little post-it note right next to your computer, right next to your computer screen that you're staring at and trading and so on, and just on there write, is this a good trade? Question mark. Why? Question mark. So if it is a good trade, yes, it's a good trade. Okay, why is it a good trade? Explain to yourself in just 20 or 30 seconds why it's a good trade. And you'll find yourself, if you ask yourself part of that question of, was there a better entry that I could have gotten? Of course, now once again, I want to re-emphasize that it would be fantastic to buy right at that little tip of that low and then to get out of it, you know, right here kind of a thing. That's not what we're looking for, but we are looking for this kind of stuff right here where there is a clear break of a double top of a several-month-old resistance level. And what are we going to do with that? Are we going to wait for a better entry that we can have a higher probability win with less risk, or are we going to jump into this thing like so many traders do, have this go against us, and hope that it turns around or get stopped out? So there's a couple of things to look at there. So again, from that chart, what we learn is buy the retest of a breakout area. Breakouts, once again, I've mentioned this already, but they retest so often, which is such good news for us because so many of us are. There's several full-time traders as always, and then there's a lot of people out there that are trading after work or before work in the morning or on a lunch break, and so we can't always get the first opportunity. In fact, many of us, even full-time traders, miss that first opportunity. So remember, we almost always have a second chance, which is so excellent. And one thing that you will notice in trading, if you are a profitable trader, patience is just a habit at this point. You're not chasing trades, you're not chasing the market, you're just patiently waiting for the next setup, or you're looking for something else to trade. So just a quick recap there. Wait for the retest of the breakout. We almost always have a second chance. If that doesn't give us a second chance fairly immediately, we continue to wait, and in the meantime, we look for something else to trade. Something that is going to make this considerably easier to do is, and will hopefully take some pressure off for everybody, is trade size. Trade size is so key and so crucial. I know a lot of people will say, okay, I'm trading 1% of my account, or 2% of my account, or 3% of my account, or I'm risking 1, 2, or 3% of my account on a stop out. That's all great. That's all fairly good, you know, money management, risk management, and so on. But you're still going to be feeling the pressure if you're risking 2 or 3 or 4% of your account on a single stop out, because it doesn't take too many of those trades stopping out before you're starting to think, okay, what am I doing wrong here? I'm eating up my trading account. It's down 10%, it's down 15%, it's down 20%. And so I'm here to say that I have been there. I have definitely traded sizes that were considered, you know, fairly conservative. I had a bad run, I had a losing streak, and the next thing you know, my account's down 10% or more, and I'm wondering what happened. So don't hesitate at all to reduce your trade sizes even considerably lower than what is considered, quote, conservative. Whatever your normal trade size is, if you feel like it's safe and conservative, cut it in half. Cut it more than half. Use a tenth of that trade size. Use a fifth of that trade size, an eighth, something like that. Just don't hesitate to hack a chunk of that off, because what we're going to do with those reduced trade sizes, number one, is be able to keep our head on straight, which is so crucial and sometimes fairly difficult to do when it comes to especially shorter term trading, day trading these markets and so on. It's hard to keep a clear head if every point of movement that the market's doing is costing us a decent amount of money and we're starting to sweat and all of that. Reduce your trade size to a point that you almost don't care if you get stopped out. Now, that's not going to be the end of it, but that's going to take a lot of mental pressure off, and so that's a big thing to start with. The next thing that we're going to do, and I'm going to talk a little bit more about this in a moment, we're going to scale into trades, which means I'm adding an additional position in profit or in drawdown. And I'll mention a little bit more on that in just a moment. And then, as I said, smaller trade sizes just take the psychological pressure off. And anytime we can do that in trading, that's a good thing. That's a good thing because, as I always say, trading is 50% technical and like 79% psychological. So my math is a little off on that, but I think it's pretty close. So just remember, anytime we can keep a clear head in trading, that's so ideal, so ideal. Okay, here's how I scale into trades. Now, let's just go back to the concept a little bit here. Larger stop losses equal less getting stopped out. It's just that simple. It's kind of the spectrum of traders, right? Have you guys heard that? You know, if you have a 10 pip loss, stop loss or point stop loss, you're going to get stopped out considerably more, but for a smaller trade size, or excuse me, for a smaller loss because your stop loss is that small. If you have a 100-point stop loss, you're going to get stopped out a lot less. In fact, considerably less than the person using a 10-point stop loss, because the market simply has more room to wiggle and more room to maneuver. So the larger our stop losses are, the less we're going to get stopped out. But it is very important to not just start using a larger stop loss, but to also reduce that trade size. So as we mentioned in the last one, you know, keep your percentages good. If you have to increase your stop loss size by 50 or 100%, you're doubling your stop loss size. Make sure that you're reducing your trade size by an equal or greater amount than that. And as I mentioned in the last portion there, I'm a huge fan of really going small trade sizes. It's not been uncommon for me to trade to use trade sizes on a $300,000 or $400,000 account that people would use on a $10,000 account. It's not uncommon at all. And the beauty about that is, again, it keeps my head clear, and it also gives me a fantastic opportunity to scale into trades. So as I mentioned here, I use larger stop losses, and if while in drawdown I see a setup that I would take if I weren't already in the trade, that's when I begin to scale in. So let's say that I'm shorting a double top, and I think that double top is going to bring the market down. Well, I'll put my trade size on there, my small trade size. I'll put my position on and I'll start shorting that trade. If it goes against me, say whatever amount it goes against me, and then I see another type of a setup that I would get into, so say it creates a triple top now, it's against me and it makes a triple top, and my original trade entry was maybe a little bit lower, so now I'm in drawdown and it's making this triple top. Well, I would get into a triple top if I weren't already in the trade. I'm already in the trade, so this is a great opportunity to scale into the trade. So I'm putting another small trade size on to add to my existing trade size. So for me, everything is setup dependent. I want to make sure that there's a setup. I don't have any hard and fast numbers. When I get into a trade, if it goes against me 50 pips, I'm scaling into it more. I don't do that at all, and in fact, I think that's very, very dangerous to do. What I do is if I get into a trade and it goes against me, and then it gives me another setup that I would get into, if I weren't already in the trade, then I put another trade on. And that could be 50 pips away or 150 pips away. So that is kind of the method that I use for my scaling in on the drawdown. Now, if the first trade that I put on goes into profit immediately, I'll add additional positions in profit as well, as long as there's a reason to add an additional position. I have definitely been saddened to see a trade that I got into and I used my conservative trade size because I was planning on scaling in if it went against me. And then next thing you know, the trade just goes exactly the direction I was looking for it to go and never pulls back a bit. And I end up with this fairly large pip value or pip run trade, but I make a pretty small dollar amount because I never got a chance to put on another position. And that's going to happen, and that's okay because there's literally an infinite amount of trades ahead. So don't worry about missing a good trade, or don't worry about not being in large enough for a good trade. That's totally fine. That's all very good. But we want to make sure that every time we do any kind of scaling that we do it because there is a reason to do it, not just because it's so many pips against us. Okay, so just a couple of quick things to summarize here. With any trade that you take, if you're ready to click the button right now and get into a trade, look back 12 hours. Did we miss a better entry? If we did, is the entry that we're getting in as good as we think it is? Is there something that we could wait for and maybe get a better entry? So look back, 12 hours or kind of to the previous session, see how things are looking. If we did miss the best entry, wait for a retest of the breakout or just for the next setup. That simple. Use a larger stop loss and a smaller trade size. That is just so very, very crucial. That has saved my life a million times. And then scale, and scale into your trades. I love scaling into trades. I almost like when a trade goes against me because it gives me an additional opportunity to put on another trade and potentially another trade and another trade. I have had trades go against me that I've scaled into 8 times. And by the time they come back around, in the worst case scenario, it wouldn't have been a big hit to my account because because I'm always starting small. And by the time the trades came around, I made more money on that series of trades than I had on many trades before. So scaling in can also be very, very powerful as well. Probably one of the most important things you can do is a strong, honest, brutal self-evaluation. Compare your most recent trades to the list. And how did you do? Are your entries at the tops of movements or at the bottoms of movements? Are you missing great areas to get in? Are you getting in early? Are you getting in late? What's happening? So go back and look at your trades and see, after you got into the trade, was there better confirmation before you got in, or was there better confirmation after you got in, or were you a long time after the best entry? Look at those things. Remember, keep those trade sizes small, expand those stop losses a bit, and jump on that scaling bandwagon, and I promise you're going to have some, if nothing else, some greater peace of mind in your trading. But I'm pretty confident that this is going to improve your overall performance and gains on your account. So thanks for coming. Hopefully this was helpful. Stop by daytradersfx.com. We'd love to have you. Ask me any questions you like. I'll put that contact page up one more time here so you can get that. Feel free to send me an email, follow me on Twitter, stop by the website. We'd love to have you. So thanks for having me, everybody. It was a real pleasure.